Imagine this. You've been saving diligently, you finally download a brokerage app, and you're ready to invest. Everyone online keeps saying, just buy ETF. They're safe, they're easy, they're diversified. So you pick the first global ETF you see, hit buy, and feel like you've made a smart, grown-up move. Fast forward a year. The US market dips, and suddenly your global fund is down way more than you expected. Why? Because that ETF was actually 70% invested in American stocks. In reality, you weren't globally diversified at all. You put almost all your eggs in the same basket without even realizing it. That's the trap most beginners fall into. ETFs are marketed as the safest, simplest way to invest. And in many ways, they are. But here's the uncomfortable truth. The wrong ETF can quietly drain thousands of dollars from your portfolio over time. Hidden fees, poor tracking, tiny fund sizes, and misunderstood risks all add up. As Warren Buffett once said, the best way for most people to invest is through a low-cost index fund. Notice the key word there, low cost. Because a fee of just 1% versus 0.1% on a $10,000 investment doesn't sound like much in year one, but over 20 years at 8% returns, that difference could leave you with nearly $50,000 less in your pocket. That's not chump change. That's a vacation, a wedding, or even a chunk of a down payment. That ends today. In this video, I'm going to give you the 10 things you absolutely must check before buying an ETF. Think of it as a beginner's checklist, your personal armor against bad decisions. By the end, you'll know exactly how to vet an ETF in under 5 minutes, so you can invest with confidence and avoid costly mistakes. And stick around, because later I'll show you the single most common red flag that 90% of beginners ignore, and it can cost you tens of thousands over time. So let's walk through the 10 things you really need to know before buying an ETF. Number 1, market or region exposure. The first thing most beginners overlook is geography. On the surface, a global ETF sounds like you're buying a little slice of the entire world. But dig deeper and you'll see a different story. Take the MSCI World Index. It's branded as global. But in reality, almost 72% of its holdings are US stocks. That means when the US stumbles, your global ETF takes the full hit. We saw this play out in 2022 when American tech stocks dropped nearly 30%. Investors who thought they were diversified because they held a world ETF still got hammered because they were unknowingly overweight in the US. Meanwhile, parts of Europe and emerging markets were doing relatively better, but those ETFs were barely in the mix. So the first lesson is simple. Never trust the word global without checking the actual regional breakdown. Sometimes diversification means holding 2 or 3 ETFs, not just one. And speaking of trust, that brings us to the next thing people forget. Number 2, the asset manager. Behind the ETF, every ETF has a name on it. Vanguard, iShares, State Street, or sometimes a smaller boutique firm. Most beginners never think about it, but the manager matters a lot. The top 3 issuers, BlackRock's iShares, Vanguard, and State Street, control nearly 3/4 of US ETF assets. And that's not by accident. They're efficient, low cost, and have decades of experience running funds. Compare that to a small issuer that launches a trendy ETF around a hot theme, say cannabis stocks or clean energy. Some of those funds never attract enough investors, and when they shut down, you're forced to sell, often at a loss. That happened to a bunch of niche oil and gas ETFs in 2020. When crude prices collapsed, investors got stuck exiting at rock-bottom prices. So just like you'd want a good pilot before boarding a plane, you want a reputable manager steering your ETF. But even the best pilot can't save you from a leaky fuel tank. And in the ETF world, that leak is fees. Number 3, fees, the expense ratio trap. Every ETF charges an annual fee called the expense ratio. And while it often looks tiny, 0.05%, 0.09%, maybe 1%, those decimals pack a punch over time. Picture this. You put $10,000 into a broad market ETF charging 0.05%. That's just $5 a year. But if you buy one at 1%, you're handing over $100 every single year. The gap is only $95 in year one. But over 20 years at 8% returns, the low-cost fund could grow to about $46,600, while the higher fee version leaves you with just $38,000. That's an $8,600 penalty for picking the wrong fund. John Bogle, who founded Vanguard, summed it up perfectly. In investing, you get what you don't pay for. That's why Vanguard's VOO at 0.03% is often a smarter choice than SPY at 0.09%, even though both track the S and P 500. Fees don't sound exciting, but they quietly make or break wealth, and that naturally leads us to another number that often gets ignored: the size of the fund itself. Number 4, fund size and liquidity. When an ETF is tiny, it's living on borrowed time. Funds with just a few $1 million under management can get shut down if they don't attract enough investors. And when that happens, you're forced to sell, sometimes right in the middle of a downturn. On the flip side, large ETFs enjoy economies of scale. They trade with tighter spreads, they're more liquid, and they're less likely to disappear. Think of SPY, which manages over $500 billion. That fund isn't going anywhere, but a niche ETF with less than $50 million. That's like betting on a restaurant that's struggling to fill tables. It may not be open next year. So, while small ETFs aren't automatically bad, stability comes with scale. And once you've confirmed the fund is big enough to survive, the next question is, what exactly is it trying to follow? Number 5, benchmark and tracking performance. Every ETF has a benchmark. That's the yardstick it's built to track, whether it's the S&P 500, the NASDAQ, or the Bloomberg Aggregate Bond Index. But here's the thing, not all ETFs track their benchmark well. Say the S&P 500 returns 10% in a year. So your ETF should come close, maybe 9.9% after fees. But if it only gives you 8%, that's a tracking error. And if it's swinging wildly compared to the index, you're taking on unnecessary risk. That's why before buying, it's worth pulling up the ETF's historical performance next to its benchmark. A little lag is normal. Fees explain that. But if you see consistent underperformance, it's a sign the fund isn't doing its job. And when a fund isn't doing its job, sometimes it's because of how it's structured. Number 6, physical versus synthetic ETFs. Most ETFs are physical, meaning they actually own the stocks or bonds they claim to track. But some are synthetic. They don't hold the assets directly. Instead, they use derivatives like swaps to mimic returns. Synthetic ETFs can have lower costs and even track indexes more tightly, but there's a catch: counterparty risk. If the bank providing that swap fails, your ETF could be in trouble even if the market is up. In Europe, around 16% of ETFs are synthetic, so investors there run into this often. In the US, it's rare, only about 1%. Still, it's something to be aware of. For beginners, sticking to physical ETFs is usually the safer bet. And once you've figured out structure, the next hidden layer is something you might not think about at all: currencies. Number 7, hedging and currency risk. When you buy an ETF tied to international stocks, you're making two bets, one on the stocks themselves and another on the currency exchange. If the dollar strengthens while you're invested in Europe, even if European stocks rise, you could still lose money once gains are converted back into dollars. That's where hedged ETFs come in. They use contracts to cancel out currency swings. For example, if you invested $10,000 in a euro-denominated ETF and the dollar gained 10% against the euro, your returns would shrink when converted back. A hedged version would shield you from that. So whenever you're looking at international ETFs, check if there's a hedged option. It can make the difference between steady gains and frustrating surprises. And speaking of steady gains, let's talk about dividends, because how they're handled can completely change your results. Number 8, dividends. Distributing versus accumulating. Dividends are a huge part of long-term returns, but not all ETFs handle them the same way. Some pay them out directly to you, known as distributing. Others automatically reinvest them back into the fund, known as accumulating. For instance, Vanguard's VTI pays dividends into your account. Great if you want income along the way, but many European ETFs reinvest automatically, which turbocharges compounding over time. Neither is better or worse. It depends on your goals. Do you want extra cash in your pocket today, or do you want your returns snowballing for the future? Understanding this up front saves you from confusion later, and possibly a tax headache too. And while dividends are relatively straightforward, the next category is where things get dangerous: specialty and leveraged ETFs. Number 9, specialty leveraged and inverse ETFs. This is where Wall Street gets creative. Specialty ETFs focus on hot themes like cybersecurity, lithium, or cannabis. Leveraged ETFs use borrowed money to amplify gains, sometimes 2 times or 3 times. Inverse ETFs profit when markets fall. These can look exciting, but they're risky. In 2020, when oil prices crashed, several leveraged oil ETFs lost more than 90% of their value in weeks. Most of these funds are designed for day traders, not long-term investors. In fact, because of how they reset daily, holding them long-term usually guarantees disappointment. So while they're fascinating to watch, they're not where beginners should put their money. Instead, your focus should stay on broad, transparent ETFs, which brings us to the final must-know. Number 10, transparency and research tools. The beauty of ETFs is that they're some of the most transparent financial products out there. Every issuer publishes a fact sheet showing top holdings, sector breakdown, fees, and performance. Websites like ETF.com or Morningstar make it free to compare funds side by side. Pull up SPY's fact sheet, for example. You'll see Apple, Microsoft, and Amazon at the top, an expense ratio of 0.09%, and a dividend yield around 1.3%. It's all right there, waiting to be checked before you buy. That's why the smartest investors spend just 5 minutes looking under the hood before pulling the trigger. Because if you know where to look, you can spot 90% of the mistakes beginners make and avoid them. Now you know exactly where to look. If you do just those checks, you'll avoid 90% of the mistakes new investors make. More importantly, you'll move from feeling like you're gambling to knowing you're investing with purpose. If this video helped you see ETFs more clearly, hit that like button. It really supports the channel, and don't forget to subscribe.